Hi, Ingo. How are you doing today?
All right. How was your week?
Quite busy, but good. How was yours?
Same. Happy to hear that, of course.
Because I'm working enough for the company.
That's the case. Yeah. So should we wait like a minute and then get started?
Yes. Just to give some of our joiners the time to come in, especially those registering on LinkedIn and just joining now. We can just give them a little more time. Yeah, today, quite an interesting topic. I think that pops out at every conversation that I have with prospective clients or existing clients. So should be quite a good one for this Friday. All right. Should we get started maybe with the company introduction, Ingo, and then we can take it from there as people are just slowly joining. So yeah, again, welcome to this Binomics webinar on price elasticities. It's one of the hottest topics, especially given the dynamic market environments in any industry. So we have quite a significant amount of registrants this time around, which shows that you're not the only one who is interested in kind of what's behind these elasticities, what are the weaknesses, can we do better, hopefully, with other solutions. And Ingo Reinhardt will be shedding some light on this today. He has over 13 years experience in pricing. He developed the Binomics method, and will kind of lead you through this presentation today. And I'm Paul. I'm leading the sales team at Binomics, and I'm the first person to speak to about potentially working with us as a client at Binomics. We go to the next slide, then I can just quickly say a few things about the Binomics solution. Binomics is a software company enabling you to make better and faster decisions in your revenue growth management and pricing. So there's basically 4 things that set us apart. We have a unique approach, not only looking at pricing in isolation, but really all levers of commercial excellence, whether you call it the 4 Ps or the 5 levers of revenue growth. We cover it all in our tool. We have very high accuracy in the tool. Also, as we can see in the solution that Ingo will demo today, we have quite a speedy solution, so you can get insights much faster than with alternatives. Lastly, it's very profitable. I think that's it from my end. Let's see, Ingo, I think you want to start to kick us off on elasticities. I think now we
happy to do so. And everyone, welcome to this webinar. So I think what we want to do is talk a bit about price elasticities, how they're being treated, how they behave, also why we are more critical about the way they're often used. And as Paul said, we also want to show a little bit of what we think is a better method or approach to model customer behavior, because that's in the end what also price elasticities are for. Understand how customers react particularly to price changes, but of course there are also other changes in the market that may happen. You might introduce a new product, change the size of a product, or make any other changes, or use promotions, for example, that are also sometimes difficult to capture properly with the price elasticity. So this is really what we want to do. And as Paul mentioned, I think it's become a hot topic. Just one indication, this paper, it's from last year, but I think it's still recent. The message is that even at the very top level of organizations, we see an increasing interest in price elasticities. Here's just one indication. So it's essentially the count of how often CEOs talk about price elasticity in their earnings calls. I had the impression in the previous earnings calls that we had, I think pretty much in the last couple of weeks, that there was a lot of talk about price elasticity, and particularly in the inflationary environment, we had many cases where if you just look at large companies as a total, where it was very common that overall revenues went up, profits went up, and sales numbers went down, which sort of indicates if sales go down, but prices go up, sales go down, always typically sales go down, but revenue increases, which indicates a low elasticity, typically a bit below -1. So when I say below -1, I mean between -1 and 0. So that was a common theme across many cases that we've seen. And in general, and if you look into annual reports, you get a very similar picture. Pricing is really at the top of mind for CEOs, particularly now in the inflationary environment. Therefore, I think particular for us pricing professionals, it's important to talk about it and also to understand what maybe the limitations are of the concept and what better alternatives are available. All right, just to get started, I think we can go over most of the stuff very quickly, but I think it's useful to kick this topic off by starting from the very basics. When we talk about price elasticity, what we're really talking about is what we want to do is we have an offer here indicated by 3 products, ABC. They have different prices, they have different features, they might have different brands, different sizes, different properties, for example. And then we have target customers who might buy some of these products, and here the color indicates what products they buy. So it's super stylized, but this is really the situation we're interested in. And if we just take these red people here, we see that depending on the price of the red product, the sales units might change. If we know the units, of course, we know everything else, revenue, profit that we might be interested in. And we see that with increasing price, of course, sales go down. And of course, what we can't show here on the slide is that there are, of course, interactions between the products. If the blue product gets cheaper, it might attract some sales from the red product. And this affects, of course, the demand curve. So this is overall the situation we're talking about. And the price elasticity is essentially a very simplified way of thinking about this challenge. And what it really does is I think the key step between reality, what happens with real customers, and the concept of the price elasticity is here captured in the demand function. And when we take the example of a linear demand function, which is, I would think, in what I've seen the most common form, is that what this really means is that we have these people down here. And in the case of a linear demand function, it means that they're standing always in equal distance. And the position where they are is essentially the maximum price this person here is willing to pay. So let's say we have a price P1, which is the current price. And at this price, everyone buys with a higher willingness to pay than this price. And if we go down with the price, then at some point, this person here will also buy the product, then this, and so on. So this is when we have a linear demand function here. It means essentially that people are standing in equal distance down here if we sort them by their maximum willingness to pay. If we have, for example, something like a more exponential demand function, which looks like this and has a constant price elasticity, that would mean that people stand increasingly closer together as we get closer to a price of 0. And there are, of course, other types of demand functions that might be applied. And the question, of course, when we use them is always also what actually is a demand function that makes sense empirically. So how is the willingness to pay actually distributed among people? But if we just continue with the idea of a price elasticity, what does it actually do? It's actually very simple. If we are standing at a certain point, a price elasticity compares the change in price with the change in volume. So for example, if we have here on top the change in price, or let's say start at the bottom, if we change the price by 1% and we lose 2% in sales, that means we have a price elasticity of -2. So far so good. It's just the definition the term. But I think the most interesting thing we can do with that, before we get into the more juicy details, is once we know the price elasticity of a product at each point, it's very easy to compute, for example, the profit optimum, because in the profit optimum, we always have the condition that margin times elasticity is -1. So for example, in the previous case where we have an elasticity of -2 and it costs us 100 euros to make the product, then the profit optimal margin is 50%, which leads to a sales price of 200, right? So if I know the elasticity of a product at each point, then it's very easy to compute the profit optimal price. It's also easy to compute the price that maximizes revenue, which of course is, if you think in this equation here, is at the case when we have a margin of, say, 100%, so no variable cost, then profit optimum and revenue optimum are the same. So the revenue optimum is at the point where the elasticity is -1. Okay, so, and it's important to note, this is only true if we're only selling a single product. If we're selling, let's say, a portfolio, good, better, best, then of course this equation isn't true anymore. And in that case, typically the prices are a bit higher, because if a customer chooses not to buy a product, and that customer might go to one of our other products, so it's more acceptable if we lose a customer on a certain product, because that customer might stay within our portfolio. So if we have a portfolio, prices tend to be a bit higher than in the case where we only have a single product. So in this case, this relationship is fairly easy. But one of the challenge, and this is already a very realistic challenge that we have, and it's based on real data. So it's based on a real case in the product category. It's a consumer goods company. They sell a product, and each one of these dots here indicates the weekly sales at different prices. So what happened here is that initially the product was sold somewhere around here, around 5 euros, a little bit above 5 euros. And then at some point, the price was increased to a little bit above 6 euros here, indicating this trend here. So sales were lost after the price increase, as we would expect. And then we have here, up here at about 3 euros, the promotion price. And when we just use a simple linear regression to estimate the dependency between price and sales, we see, and we draw this line here through the non-promotion products, we see that the promoted products are a bit higher, indicating that there is an extra promotion effect, as we would expect. But we also see that in the case of a linear regression, the price elasticity is different in each point, which is, of course, a problem. And if you're working with agencies who give you who compute price elasticities for you, then the question is always, and this is the work that's underlying this analysis, it's always the question, which one do you get? Do you get the price elasticity at the highest price, which is 4.8 in this case, or at the lower price before the price increase, it's 2.2, it's already very, very different. Or if you think you have a price down here at the promoted price without the promotion effect, the elasticity that comes from that linear regression here is minus 0.7, so much lower. And for everyone interested, so if you have a linear regression, it's easy to compute the price elasticity. It's just the slope times the price over the intercept plus the slope times the price, where B, the slope, is typically negative, because if we increase the price, we typically lose sales. And you also already see that the elasticity of this product takes every value between 0, if the price is 0, and minus infinity at the point where we lose all sales, because it's the maximum that's allowed by the linear regression here. So it's really difficult already. We see this in this simple example to say the price elasticity of this product is X, minus 2.2, minus 2.8, 4.8. So it really depends, and that's important on what the current price is, and that's not just theoretical, that's very practical, right? If you go from 5 to 6, elasticity goes from 2.2 to 4.8, so quite an increase. And also the promotion elasticity, which in my experience is often also given as a number by many agencies, really depends on where you start. So if you start at the lower price, the promotion elasticity is very different. In this case, identical. If we go from here to here, it's minus 2.2, and if we go from here to here, it's minus 3.3. So also there a massive range of different price elasticity, and it's really not clear which one is the correct one to use. And also we're not showing this here on the slide, but you have similar challenges if you use, for example, or if you're crossing price threshold and work with an increased elasticity for crossing the price threshold. All right, so that was, I would say, like the first type of difficulty with price elasticity. And of course, there are many more. So you usually have a price elasticity, as we had up until now, that you have for the case where we're increasing the price or decreasing the price of a single product. It says -2 as in the example before. If the product is promoted, also as we've seen before, the price elasticity becomes higher, typically because we have an extra promotion effect, because as we have the promotion, the product becomes more visible and attracts more sales, resulting in a higher price elasticity here. But other effects are also relevant. So if we don't just change the price of a single product, but of the whole category or our whole portfolio, we see that elasticities are typically much lower, because if you not only, let's say we're looking at product B or product A in this case, we increase all these prices, then for the one effect is that for those who would move from product A, if we only increased A maybe to B or C, don't do this anymore because B and C also become less attractive. And also we might gain some of the customers from product B or C because these will also increase. So typically if we increase the whole portfolio, elasticity is much, much lower. The same can be true if we have a change in our portfolio. So we replace this product C with the product D. This, of course, also has an effect on elasticities, and also if we have any other change in our setup. So there are lots of things that can happen, and they're not very well captured in a single price elasticity number. And just to conclude this topic, of course, price elasticities, they come from a different tradition compared to behavioral pricing. They make assumptions about rationality, at least implicitly, typically. So they're very difficult to align with behavioral effects. I already mentioned the price threshold, but also difficult to align with like a good, better, best design, anchor products, and so on. They don't help with product features, which I mentioned before. And also what we've seen, because it's difficult to assign a single elasticity number to a product, here it ranges between 0.7 to 4.8. It's also difficult to describe elasticity with like qualitative features where you say, okay, luxury products are less price sensitive than mass market products because the customers are less sensitive. I think what really happens in many of these cases is that for luxury products, the competition is much less relevant, and therefore we can show this in the tool in a minute. That's what produces the typically lower price elasticity for luxury products, for example. So having started with elasticities, and I think it's the way essentially to see it is what elasticities do is they come essentially from a microeconomic foundation that comes from a time maybe 200 years ago when it was difficult to do proper computations. And essentially, everything had to do with paper and pencil or in your head. And that's a world in which a concept like a price elasticity makes a lot of sense, right? So you say we increase prices 5%, lose 10% in sales, price elasticity is -2. That's something that's very straightforward and easy to compute in our head. What's, of course, now with complex portfolios, different alternatives, almost in no buying situation, customers just look at a single product. Typically, they look at a portfolio of your own products, competitor products, so it's a complex situation. The whole situation becomes more complex, and particularly for large enterprises with lots of revenue at stake, it makes a lot of sense to be much more precise and understand and look in detail what really happens in the market, and also what happens in the interaction between different products. And this is essentially what we want to show, and how we think that the next step in understanding these customer dynamics should work as we progress from like a more simplistic price elasticity concept that makes it easy to do essentially back of the envelope computations in your head, moving to a world where we do actually more professional pricing decisions when large sums are at stake. And essentially the technology that we're developing uses the concept of, which we're showing here, of a virtual customer or virtual shopper. And the idea is that using different sources of data that are available, we estimate the preferences, the willingness to pay for these customers for different products, different features, and that allows us to assess how much different of these customers would buy in different situations. So if we have a portfolio of these 3 products, what would happen if we just change the price of one of them? What happens differently if we change the price of multiple of these products? And just give me a second, I will show you what this looks like. Well, can you tell me if you can see my browser?
Yes, we can.
And let me just switch back and start with the simple example. So just to get started, a very simple example that's very close to the 1 or 2 product case that we had before. So we're selling apples. Let's say we have one competitor sells pears. We have different price, so we both sell at 130 here. We have costs at 50 cents each case, and we sell to a certain audience of people. And what we see here is we at the price of 130, we sell 200 units, 223, the other tells 225. So we have a pretty much the same willingness to pay for our products. And what we see is that if, for example, we increase the price of our product here, we have a price elasticity of -2.9. If we increase the price further, elasticity goes down. So it's computed specifically for a specific situation. Let me just go back. But we also see what we mentioned before. If everyone in the market increases the price, our price elasticity goes down because the alternative becomes less attractive than in the case where only we increase our price. And that is something that's, of course, relevant for these market dynamics. So if we look at the sales here for the 2 products, we have different price points, we have different units. And if we have resulting, of course, our revenues and our competitors' revenues here, we see that our profit were a bit too expensive for the profit optimum. And of course, what the focus is today, we have here our price elasticity at the current point. So for us, it's 2.9. For the competitor product, it's also 2.9. And we see what we said before, if we increase our price, that our elasticity goes up. So it goes from 2.9 to 5.9, but making the product much more elastic. And this is also particularly now in the inflationary environment, something where people notice we increase price, elasticity goes up. Nothing really has changed. It comes from the same demand function, right? The increase in elasticity purely comes from the fact that you have increased the price, not from the fact that preferences have increased. And we see that if, for example, our competitor also, so we're now here at 5.9, if our competitor also increases the price, our elasticity goes down, in this case to 4.8, which also indicates this interaction between different products. So if others also increase the price, then our elasticity becomes much, much lower. And this is also something that we're seeing in many industries where in most cases, not just one competitor increases prices, but everyone increases prices. And in those situations, we see much, much lower elasticities than compared to cases where only a single product or a single brand increases prices. So we see this in this simple example. And let's say we look at a more realistic case where we have a full portfolio. So we have here 4 products. We're selling peanuts of different sizes from 1,000 grams to 250 grams. And we have 3 competitor products. We are really seeing the same type of effects here. Namely, that if we increase the price only of our product, in this case, we can have a very, very high elasticity. But if we increase all the prices in our portfolio, we see that elasticities drop massively because people don't, it's much less attractive for everyone to switch within our portfolio because everything has increased in our portfolio. So this is, I think, the core effect. And also, this allows us to be much, much more precise in understanding how demand reacts to changes in prices. Than with the simple price elasticity. So when you're just from a regression analysis, just get a single number that doesn't really tell you all that much in many cases. Somewhat like a broken watch, which is correct in some place, but it's not incorrect in all of the places. So this is really how price elasticities work, and you really only get the proper dynamics of how units change between cases if you have something like this and you're able to understand the full impact of all the changes that are being implemented in the market. And for this, you need to understand not only look at the single product, but look at the full portfolio. And as you can see here, for example, elasticities, if you just compute them, might actually be positive because this product gains more from the other products than it loses from its own price increase. All right, and just to conclude this part here, what you can also do is, for example, when you're dealing with inflation, understand, so this is the situation I just showed. We have these 4 products. Now we have a COGS increase of 20%. So, and if we don't change our prices, everything else stays the same, revenue is the same, but of course our profits go down because our COGS have increased. And if we now want to understand what our options are, so we can also increase all our prices by 20%, this is where we come out, or we can, as an alternative, also consider what happens if we decrease all the sizes of our products by 20%. So we go from 250 to 200, from 1,000 to 800. We see what the profit impacts are. In this case, it's less profitable, but it allows us to very easily look at all of these changes and be in a position to very quickly make a proper assessment of the situation. All right, so this was just a brief outlook or look at what we think is the better way to deal or to look at price elasticities in a better way. To capture the full dynamics in real markets and not just have this very simplified, maybe simplistic concept of a price elasticity to assess how customers react to price changes. Paul?
Great. Thanks, Ingo. Super fascinating presentation about the different nuances of how price elasticity can be tricky to deal with. both in terms of fundamentals, but then also in terms of like other factors that play a role in influencing buyer decisions. So quite fascinating. And we also sparked some questions in the chat. I'll start with the quickest one from Isabel, who's asking what data informs the virtual shopper profiles?
Yeah, so can't go into full detail now. I think we have separate sessions on this, but in general, we work with the same type of data that's typically available for pricing. So it's sales data, transaction data, but also survey data. They all have different advantages and disadvantages. And what we do is we convert them or read out the preferences of the shoppers in a segment to parameterize the model and then use that to make these assessments that we just showed in the solution.
All right. And then someone else is asking, Justin is asking, how do you model the purchase decisions of virtual customers? Are these modeled as indicator variables? Each customer purchases most one of the competing products or none at all. Do you also model purchase amounts of individual customers depending on prices?
Yeah, so there are different ways. Depends a bit on the situation, but in general, it's a utility model where customers get utilities from different products and compare that to the price they pay, and then they essentially buy the product or products that maximize their utility.
Okay. And then there's some more longer questions. So Nikhil is asking, what fundamentals exist to understand these elasticity points for industrial goods, where machines are a mix of standard offerings and aftermarket, but volume of these offerings is extensively large with very low amounts of competitor data available? How do you face these challenges of defining elasticities for your clients?
Yeah, so it's a very long question. Maybe we have to answer it offline, but so the short answer is this. I think it's from B2B context, and in B2B context, you typically don't know, you don't have full transparency on what your competitors do. That's one thing. So you need to find a way to cope with that. And the other thing is, in these one-to-one offers, you don't have sales volumes, but you have essentially purchasing probabilities that function a bit similar to price elasticity. So in a sense, you can compute with them in a similar way. And what our model or the parameterization does is read out the situation so that, or build the model so that it can predict the purchasing probability of specific customers, knowing like details on the customer, what industry they're from, how large the purchase volume is, and also features of the product. So it's a similar way, but I think the key distinction is there's much less transparency on competitors, and you don't have typically sales volumes in the same way as you have in the example that I showed here, but you have essentially purchasing probabilities because you're looking at a specific deal from situation to situation.
Yeah. So it's more like bit optimization. So another question here is saying, how do you take into account customer reactions for events in times like COVID?
Yeah. So I mean, of course, you can't predict the start of COVID, but I think from our experience, we saw that afterwards, in many cases, the situation normalized quickly in the sense that total sales volumes were affected much more strongly than, for example, market share of different products. And there are different things that are easier to predict than others. And I think from our experience, predicting or getting the market shares right is much easier than getting the total sales volumes right, particularly in the beginning of COVID, where you had a few weeks that had very unusual sales volumes. And typically you afterwards you have, because of lockdowns, for example, and other effects, a different equilibrium, but within that equilibrium, the typical market forces were in most cases, I would say, quickly stable again.
Okay. And then maybe last question here, just in the interest of time. What about price elasticity in more complex environments like project business, where the dimensions, products, and customers collide with many other dimensions like deal size, specifications, and others? I think it's another B2B question about, and then I think
I think our focus so far has been mostly on B2C, but maybe if we have more B2B questions, we should also have a separate session on B2B at some point, maybe not too far away. And so, as I said, there are some specific challenges in terms of the data transparency. You typically don't know much about your competitor offers. And if you're looking at individual sizes that also depend on the customer, it's not about sales volumes in that situation, but about the probability that a customer buys your product and not something else.
All right. And then someone's also asking, how do the different elasticities of the different products interact, and how can you have a positive elasticity?
Yeah, so in the case with the positive elasticity, what that essentially means is when you increase the price of all products, it might be, or if you increase the price of different products and to different degrees, one product might gain more from the others than it loses because of its own higher price. So, and if you just compare old price, new price, old volume, new volume, then this can technically turn into a positive elasticity. If you want to use it, of course, you have to put it in the right framework, right? So this number is only valid for this specific situation. And if you, for example, just want to increase the price of that product, then it will most certainly not be positive if everything else stays the same.
All right. I think that's all we have time for in terms of questions today. Can we go to the next slide, Ingo? Because we have another webinar coming up, but I also want to mention that for everyone that is working in the telecom space or is just attending the Mobile World Congress next week to inform themselves about the latest and greatest in telecommunications. We will be at the in hall between hall 4 and 5, so please feel free to contact us to have a meeting. I'm posting the meeting link in the chat, and if you want to learn more about elasticities or how we work with clients across industries, don't hesitate to book a meeting with us. And you can, of course, always book a meeting also on our website. If you're just interested in Binomics in general, we can have a quick meeting and just discuss a little bit your challenges and how Binomics can help with those. For the next webinar, I think we're going to be talking about behavioral pricing, but that will be in 2 weeks. You will receive a separate invite, so check your inboxes on Monday, Tuesday, and we'll see you at the next one.
Thanks, and have a great weekend. Thanks.
Thanks, everyone. Bye-bye.